Hello and welcome to the latest Expert Series webinar. Today's presentation is Advisors Alpha, the Value of Enduring Advice. This is a complimentary ETF.com webinar courtesy of the Vanguard Group. I'm Ollie Ludwig, the managing editor of ETF.com, the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Joining me today are Colleen Giaconetti and Fran Canary, both of Vanguard. Colleen is an investment analyst in Vanguard's investment strategy group. She has worked extensively with a broad range of clients to create investment strategies and establish best practices for investment success. Fran is a principal at the Vanguard Investment Strategy Group. His main responsibilities are capital market research, portfolio design, development and implementation of customized investment solutions, investment market commentary, and research. Before we get started, I'd like everyone to know that they can ask any questions at any time during the webinar in the window at the lower right of your screens. And bear in mind that this presentation will be available to all of you 24 to 48 hours following today's webinar. Vanguard is the world's biggest mutual fund company. Counting money market funds, it now has about $2.3 trillion in assets under management. The company is also the third largest ETF provider in the world, and its U.S. listed assets in exchange-traded funds now total more than $386 billion in 67 ETFs. Focusing on Vanguard's big and growing place in the world of exchange-traded funds is a perfect springboard to start this discussion on Advisor Alpha. After all, we're talking about a financial advisory landscape that is in major transition. Advisors are increasingly fee-based, and registered investment advisors have been leading that trend away from the commission-based brokers of yesteryear. And at the center of this trend is the ETF, which is quite light and free of most of the Wall Street gravy train associated with so many mutual funds. ETFs don't have load fees, no annual trailers, and not least, the expense ratios on ETFs are considerably lower than those on mutual funds. So it comes down to relatively small expense ratios, and we all know Vanguard is pretty much the conscience of the fund industry when it comes to low fund fees. And on top of those expense ratios, the advisor's fee. And the advisor's fee leads us to the central question in today's webinar. What can advisors do to help their clients achieve their investment goals? Attendees of ETF.com's Inside ETF conference early this year in Florida got a taste of the way Vanguard looks at this question with Vanguard's Chief Investment Officer, Tim Buckley's keynote address. Not surprisingly, Buckley talked about low cost as a sure way to increase returns, but he also singled out other things like being tax savvy, rebalancing, and not least, behaving reasonably in adverse market conditions. In sum, Buckley said staying on top of all these factors could be worth as much as 3 percentage points of extra return each year, or at least not losing those 3 percentage points for lack of doing the right things. We'll hear quite a bit about those 3 percentage points today. So let's get right into it with Colleen Giaconetti and Fran Canary. Fran?
Thank you very much, Ollie, and thank you all for attending today's session. We appreciate the interest. As Ollie mentioned, Vanguard established the Advisor Alpha concept in the early 2000s. We are a research-driven group, the investment strategy group, that focuses on the capital markets, but we also focus on practice management, and Vanguard has long had a relationship with the advisor community, advisors as financial stewards for end clients. And so we developed the Advisor Alpha concept about 15 years ago, and within the last 12 months, we went from theory to putting some numbers behind that. And the number that Tim Buckley, who's my boss, presented at the conference was about 3%. And really what we wanted to do is figure out, or at least describe to you all, where we came up with that 3%. So within each module today, we're going to go through them one by one, but at a high level, I'll walk you through each one individually. So there are 7 modules, as you're seeing here on slide 3. And some of these you may see a range, and I'll go through that, why there's this range. So we start off with the asset allocation. As we all know, setting a policy portfolio of the mix between high risk and low risk assets can add substantial value through time, but also can expose investors to risk that they're not comfortable with. Colleen will walk through that, so I'm not going to go through. I'm just going to give a little bit of a taste of each one. The reason why we have greater than 0 without a specific number, we were really careful in this research to look at dollar-weighted total mutual fund assets and then see what type of improvement we could ascertain to put a number on. As you can imagine, the right asset allocation is very unique to each client. So we do know that this is a significant value to the advisor value proposition. We see many clients come in with 20, 30, 40% in money market assets that certainly could be put to work in better use. We see investors not really having a top-down methodology, and so certainly we think that the right investment policy or allocation is significant, but to put a number on that, we would have to figure out what investors' baseline was for the benchmark and then figure out what the advisor moved them to, so we did not assign a value. So the good news is the about 3% does not even account any for having the right asset allocation. The second one we can actually put a real hard number to, cost-effective implementation, and that is strictly the advisor community using the lowest cost funds that are available. And for this, again, high level, we'll go into it in more detail. We just took the dollar-weighted expense ratio of mutual funds today versus a low-cost cohort that are available for the advisor community to buy, and we came up with a 45 basis point number in the advisor alpha model. Rebalancing, we came up with 35 basis points. Again, we will go into this in detail in the rebalancing section, but here again we were able to put a very firm number on that because we actually have asset allocation by month, and we can see that investors who are not rebalancing and more in drift mode, and we can also see that investors have a higher risk through rebalancing, and we were able to assign a very hard number that we feel comfortable with. Asset location and spending strategy, we have a range, which is module 4 and 5. Just real quickly why there's a range. For example, if the client has 100% of their assets that are taxable, there's not much you can really do with asset location. Asset location really requires the investors to have assets in taxable, tax-deferred assets to add value through the asset location process. Where the number approaches the 75 basis points is when the division of taxable to tax-deferred assets are about 50-50. So obviously all taxable assets, the answer would be 0. All tax-deferred assets, the answer would be 0. And then as you get towards the situation where taxable and tax-deferred are close to equal, you would get toward the high end of that 75 basis points. Spending strategy, same thing here, depending on your asset makeup between taxable and tax-deferred and how you withdraw can make a significant difference, but it really depends on how the assets are allocated. Total return versus income investing is very much like the asset allocation. We know it's a real number. We know the advisor community can add a lot through a total return concept where we're generating income to investors through a total return rather than through high yield seeking assets, but not having a baseline portfolio on that. We just have that at greater than zero. The last component, which is the largest component, and about half of the 3%, is behavioral coaching. This is another number that we feel very confident in the research. And here we use the internal rate of return, which is the IRR, which measures cash flow, which is the actual experience of investors, to the time-weighted return, which does not account for cash flow. And so here we can actually put a very firm number on the value added from behavioral coaching. Staying the course, not chasing returns, talking investors on their own out of doing things, and we're very comfortable and confident in this number at 150 basis points. So that's how we arrived at the 3%. I just wanted to introduce where we came up with this and then each module. And now I'm going to turn it over to Colleen, who's going to cover in detail a couple of the modules in order. We're going to go 1 through 7, and we'll hand it back and forth.
Great, thanks, Fran. The first tool we're going to discuss is asset allocation. As Fran mentioned, we're not going to go into a lot of detail here. We're all aware that asset allocation is the primary determinant of risk and return in a broadly diversified portfolio. As the chart shows, investing is a trade-off between risk and return. Stocks provide long-term returns with higher risk, and when combined with the high-quality bonds, the volatility and magnitude of potential loss are reduced. We've deemed this the value of selecting the most appropriate asset allocation for your clients as significant but too unique to quantify, because each client's time horizon, risk tolerance, and goals are highly individualized and variable. It will be difficult to quantify and then extrapolate how you would have gotten your client who exited the market before and is sitting in cash today back into all equities, or the value of diversifying the equity holdings of a client who's 100% company stock. We could not find a way to extrapolate that across all clients for an experience to put an exact number on it. But having said that, just because we can't put a definite number on it doesn't mean it's not important. We firmly believe that asset allocation and diversification are two of the most powerful tools you can employ to help your clients achieve their goals and manage investment risk in the process. As a result, when implementing your client's asset allocation, we would say keep it simple. We view simple as a strength, not a weakness. So a portfolio that provides the simplicity of broad asset class diversification, low cost, and return transparency can actually enable your clients to comfortably adopt your investment strategy and better endure the inevitable ups and downs in the markets. In addition, a traditional long-only, highly liquid investable portfolio of 60% stocks and 40% bonds has been very competitive when compared to what some may consider some of the most sophisticated investors, namely endowment portfolio managers. This chart is based on an Akubo Common Fund study, and Akubo, for those of you who are not familiar, is similar to Morningstar, but for endowments and foundations. And this compares the performance of the 60% stock, 40% bond portfolio, here outlined in the dotted maroon line, to that of large, mid, and small endowment portfolios over the last 3, 5, and 10 years. As you can see, the 60-40 portfolio outperformed the vast majority of these endowment portfolios, who have professional staff that spend all their time trying to outperform the market and really can invest in any different investments. So this is not to say that these managers do not provide value, but rather it can be very expensive to try to add this value, and oftentimes the cost exceeds the benefits.
Yeah, I would just add to this study. This is a study we've been tracking also for quite a while. And we're not saying that 60-40 is the right allocation for any client. That happens to be the common benchmark of the endowment universe. What this really shows is the idea that you need private equity, hedge funds, liquid alternatives, non-traditional asset classes that have oftentimes very, very high costs, and oftentimes the manager dispersion is very high. This to us shows that the long only traditional simple portfolio has been extremely competitive with the best and the brightest, which is the endowment universe, and has outperformed 90% of the endowment universe, 100% if you count 3 and 5 year, but 90% if you count the last 10 years. So certainly the idea that you need to do more or move more towards the emulation or mirroring the institutional model does not really hold up well when it comes to performance.
Great. So the next tool, which is cost-effective implementation, really comes down to simple math. Gross returns less cost equals net return. So every dollar paid for management fees, trading costs, and taxes is a dollar less of potential return for your clients. And for fee-based advisors, this equates to lower growth on your assets under management and therefore lower fee revenues. As a result, cost-effective implementation, in our opinion, is a win for you and a win for your clients. Research has repeatedly shown that low costs are associated with better investment performance. Therefore, we believe cost should play a role in the investment selection process. And with the growth of the ETF marketplace, you now have many more low-cost investment options to choose from. As Fran mentioned, we believe the potential value add here is about 45 basis points annually by moving to low-cost funds. And this value add is the difference between what we would call the average investor experience, measured by the asset-weighted expense ratio of the entire mutual fund and ETF industry. That would be the first line, asset-weighted expense ratios on this chart. The next line would be the lowest cost funds within the universe, which will be the middle line. So as you can see here, for a 100% bond portfolio, the asset-weighted expense ratio, so the average investor would be paying all in 47 basis points, up to 61 basis points for a 100% stock investor. As opposed to the lowest of the low, that would be the lowest quartile of funds within this universe, where an all-in bond portfolio would be 12 basis points in cost, and the 100% stock portfolio would be 15 basis points. So this is where we came up with the 46 or the 45 basis points of additional return. And the important thing here is this only includes the explicit carrying costs or expense ratios. So it's extremely conservative when taking into account all investment costs, which often include sales commissions and 12B1 fees. And if your clients were previously invested in higher cost funds than the asset-weighted averages we're showing here, the increase in value you could provide to them is likely to be even higher. This topic has received a lot of attention lately, as investors and clients are far more mindful of the impact of costs on performance. And we would say this is evidenced by the cash flows of the last 10 years. So these two charts are the cumulative cash flows going into U.S. equity funds and ETFs on the left, and U.S. bond funds and ETFs on the right. So within equities and bonds, we quartiled each of the cash flows by cost. So Q1 is the lowest cost funds, and Q4 would be the highest cost funds. The number in parentheses in the legend is the asset-weighted expense ratio for that quartile. For example, the asset-weighted expense ratio for quartile 1 for equities is 40 basis points. For quartile 4, it goes up to 187 basis points. So as you can see on the equity side, assets have been pouring out of the higher cost funds. So Q2, 3, and 4 have all had negative cash flows, and it all seems to be flowing into Q1 or the low-cost funds. Similarly, on the fixed income side,
excuse me, Colleen, Ollie here. Quick question on that. So that's a really fascinating graphic there. Is that telling us a lot about ETF flows there, relative to mutual fund flows in the past few years? Certainly on the equity side, there seemed to be a zero-sum game going from the flows we track. Is that quartile where it's hockey sticking up? Is that probably ETFs in your judgment?
I think, yeah, it's Fran. I think the hockey stick, the end part of that is the adoption of ETFs. But we actually have run this study active only, and you don't see the slope of the line nearly parabolic, but you do see Q2, 3, 4 having negative flow, even if you remove indexing and ETFs from that. So I think what has happened is with the lost decade and low costs and the movement towards the fee-based model, which you mentioned in the intro, has really created this low return environment and the need to try to lower costs of assets, whether they be indexing or active.
That's great. Thank you.
I would just add on the fixed income side on the right, ETFs started significantly later, and so the chart looks like a similar slope and a similar adoption, but ETFs in the bond world are probably 5 to 10 years behind development and a historical performance. A lot of institutional investors and other investors require 3 and 5 year performance before it can be added to a buy list. And so fixed income ETFs are about 10 years behind. So we would expect the adoption of low cost and indexing in the fixed income side to look much more like the equity side, and you're starting to see that.
Right. Interesting. Thank you.
We're going to shift gears to rebalancing, and so I'd just like to orient everyone to slide 8 and what is going on with slide 8. The blue surface area on this chart is equity allocations for all mutual fund assets, and that includes U.S., non-U.S., so developed non-U.S. and emerging. This does include ETFs and mutual fund assets. So this is basically the mutual fund and ETF landscape equities. The green surface area is bonds, and then the top lighter blue is money market. And so what jumps out to me right away is that most investors, and again, I want to be very clear in my comments, a lot of times people will look towards mom and pop investor, retail investor, but 80% of assets are intermediated in one way or another. They are either run by an investment committee or they are run by an advisor. And so when we look at all mutual fund assets, it's easy to lay blame or easy to make conclusions that this is the retail, when in fact, if 80% of AUM or assets invested are intermediated for an end investor in one way or another, what we're looking at is really, this whole presentation is more sophisticated behavior of the intermediated channel. And so what this shows is that in 1993, which is as far back as we have data for, investors were exposed to 34% equity. And if you look, basically you see a portfolio that is on drift. At the peak, of the internet tech bubble, investors had about 62% of their assets in equity. And then if you follow this down in the internet, when the internet tech bubble collapsed, investors had a minimum there of about 40% equity. So they rode the equity wave up in the mid to late 1990s, hit about 60%, rode it all the way back down at the bottom there in 2003. Surely enough, as we all know, coming out of the internet tech bubble and in front of global financial crisis, the market peaked in 2007 and investors rode it all the way back up to having 63% in equities right in the face of the global financial crisis, and then rode it all the way back down. If investors and or advisors and or investment committees were dedicated to rebalancing, you would see the blue surface area be flatlined. You would see rebalancing to policy, and maybe not flatline, but certainly a much more even range around the policy portfolio. But what you see is that investors on their own or advisors and committees having a very, very difficult time staying rebalanced to their policy portfolio, and it is trend seeking. So it is momentum following the returns of the market. As we sit here today, this data ends at year end 2013, but we've started off 2014 with strong equity flows and strong equity markets. We are near peak equity flow. It kind of cracks me up every time in the media when I read that investors have not participated in this market, and maybe that's true because the front end of the rally, they started with 38% equity, but investors have not de-risked. We are near peak equity allocation, and so certainly investors and advisors have had a hard time staying to the policy portfolio, and that's a big deal in our opinion, because the next slide will clearly show how we think about rebalancing and the opportunity cost of this drift. So what we have here on slide 9 is a 60-40 portfolio is the first line, and you see that the average return to the 60-40 portfolio that is rebalanced has a return of about 9.1 with a standard deviation of 11.4. The drift portfolio, which is what we just showed, which would be actually very conducive to a benchmark or a proxy for our investors, is a portfolio that is just on drift. And obviously, I want to be very clear, rebalancing is about risk mitigation, not return seeking. Because if you have a high returning asset, stocks, to a low returning asset, bonds, you're going to, on average, over long holding periods, have more of the high risk, high return asset. You're also going to have a much more risk, which is evident in that 14.2 versus the 11.4. So you get marginally higher returns, 9.4 versus 9.1, but significantly higher risk. So our advice is, if you can stomach the volatility of 14.2, or you can use downside value at risk, whatever measure you want to use for risk, get to the right allocation from the get-go, which here what we did is we risk matched. The 14.2 drift actually has a risk profile similar to 80-20 that stays rebalanced. And so in risk matching, we would say take the highest equity allocation that your client can stomach, only to the extent that you are confident that they are going to rebalance in the best of times and the worst of times. And that is how we think about the allocation process, right? So we believe in the equity risk premium. We believe in getting the highest equity exposure that the client will stay committed to in the worst of times and the best of times, because it's not all just about 2008. We also see investors not rebalancing in the peak as well. So it's balancing remorse and regret and making sure that we have the allocation dedicated to where we feel the client will stay dedicated to that rebalancing and get to the allocation that we feel comfortable with in both of those times. And so there you can see how we added the numbers to our rebalancing methodology in getting to that allocation for Module 3, rebalancing.
Fran, quick question. Something came in from the audience, which I think is a propitious time to jump in. Does Vanguard have a general idea about how often rebalancing should occur, or is that really a judgment that has too many variables to answer in a really clean, crisp way?
Yeah, Ollie, we actually do, and Colleen Giaconetti, who's here with me, actually authored our paper, a white paper, and I'll put a shameless plug in for our research paper. All of our research can be found at Vanguard.com, but I'll let her talk about it because she is the author of the paper.
Great.
Perfect.
Thanks, Ollie. When we look at it, we think investors should really look at their portfolio every 6 to 12 months, and they should only rebalance the portfolio if it deviates from the target allocation by 5% or more. So if you're a 50-50 portfolio and your portfolio drifts above 55% in stocks, then we would say on the anniversary date, not in response to any market events or anything, but on a specific anniversary date, you would then rebalance back to the 50% stocks and 50% bonds.
Yeah, we did stress test actually so we looked at it doing it daily, we looked at it monthly, quarterly, semi-annually, whether you had, you did it all regardless, even if you were 1% over. We actually did it episodically, meaning after a big event. So after Lehman fell, after October 1987, and the results were quite surprising that, you're out 2 and 3 decimal places in Sharpe ratio by doing it either too frequently or after an event. So we came to this conclusion, a lot of our advisors are working with taxable clients. Ideally, you'd want to rebalance inside tax qualified plans, but that's not always the way it goes. So the methodology that Colleen just described is quantitatively not only the answer we came to, but there's nothing you can do better by doing it more frequently or after big episodes.
Okay, so the next tool that you can employ is asset location. The next module is asset location, which is really the allocation of your client's assets between their taxable and tax-advantaged accounts. So this is one way you can add value each and every year with the expectation that the benefits will compound through time. So from a tax perspective, we feel the optimal portfolio construction minimizes the impact of taxes from holding tax-efficient broad market equity funds and ETFs in taxable accounts and holding taxable bonds within tax-advantaged accounts. So this arrangement really takes maximum advantage of the yield spread between taxable and municipal bonds, and we believe it generates a higher and more certain return premium. And these incremental differences can compound through time. So our research has shown that constructing the portfolio in this manner can actually add up to 75 basis points of additional return the first year without increasing risk, and this really depends on the investor's asset allocation and their bucket size. The majority, as Brandon mentioned previously, of the benefits of asset location occur with the taxable and tax-advantaged accounts are roughly equal in size. The target portfolio is somewhat balanced, and your client is in a high marginal tax bracket. As Brandon previously mentioned also, if your client is all taxable or all tax-deferred assets, the value of asset location is really zero. So the next module is withdrawal order, and this is becoming increasingly important. With the retiree population on the rise, an increasing number of clients are facing important decisions about how to spend from their portfolios. Complicating matters is the fact that many clients hold multiple account types, taxable, tax-deferred, and/or tax-free accounts. We believe advisors who implement informed withdrawal strategies can minimize the total taxes paid over their client's lifetime, thereby increasing their terminal wealth and the longevity of their portfolios. So in our opinion, this process alone could represent the entire value proposition for a fee-based advisor. Advisors can really minimize the impact of taxes by spending in the following order. So required minimum distributions. So these would be the first monies used. This is applicable for clients who had tax-deferred assets and are over 70.5 years old. After this, you would spend cash flows on assets held in taxable accounts, then spend from taxable assets, and finally tax-advantaged assets. So our research has shown that spending from the portfolio in this manner can actually add up to 70 basis points of average annualized value without any additional risk. So in order to calculate this figure, we compared the internal rate of return as shown in the chart of this spending order, so our recommended spending order, to that of 2 alternate spending orders in which the tax-advantaged assets were tapped prior to the taxable assets. So in the first strategy, we would tap tax-deferred assets. This would be traditional IRAs or 401k assets before spending from taxable accounts. And in the second one, we would spend from tax-free accounts, so that would be Roth IRAs or Roth 401k assets before taxable assets. So as you can see, in both cases, accelerating spending from tax-advantaged accounts resulted in lower terminal wealth and a lower IRR. So here, our spending order, over the 10,000 scenarios that we looked at, we had an IRR of 4.4%. From the other two, it actually drops to 3.7 and 3.6% respectively. Again, this one has a range. This module has a range. And the extent of the value will depend on the bucket size, again, how much is in taxable versus tax-advantaged assets, and each client's marginal tax bracket.
Yeah, and I would just add to this slide, this is an area where we see so many investors. Actually, this is kind of linked to asset location. Since they want to spend their taxable assets first, they inappropriately will have cash or corporate bonds and other things in there. So, as we enter the distribution phase in a low-yield world and less clients having DB assets, we firmly believe that the advisor alpha value proposition could be on distribution or generating income alone for a client demographic that's going to have a very, very hard time as they move from accumulation to generating an income stream.
Great. So the next module is total return investing, and this has also become increasingly important in recent years. With yields on balanced and fixed income portfolios at historically low levels, and the anticipation that yields will remain low through 2014 and 2015, the value of advice has never been more critical for retirees. Historically, retirees holding a diversified portfolio of equity and fixed income investments could have easily lived off the income generated by their portfolios. Unfortunately, that is no longer the case. Investors who wish to spend only the income generated by their portfolio, referred to in this chart here as the income-only strategy, would have to have three choices if their current cash flows fall short of meeting their spending needs. So they can spend less, they can reallocate their portfolio to higher yielding investments as seen here, or they can spend from the other part of their total return, which is the capital appreciation. So given this choice, many clients don't want to hear they should spend less. In addition, many clients are hesitant or resist spending from the principal on their portfolio, which really leads them to putting pressure or deciding to do this on their own of reallocating their portfolio to higher yielding investments. But what many of them don't realize is that moving away from broadly diversified portfolios for the sole purpose of increasing current cash flow could actually put their portfolio's principal at higher risk than just spending from it. So one of the strategies that people would do here is the first one is the overweighting or increasing the yield on their portfolio by increasing their allocation of higher yielding bonds, which are often exposed to marginal or even significant credit risk. So we have research that shows that replacing existing fixed income holdings with high yield bonds has historically increased the volatility of a balanced portfolio by about 75 basis points annually. This is because high yield bonds are more highly correlated with equity markets and are more volatile than investment grade bonds. So this risk actually tends to be magnified when investors move in to these bonds at the expense of their U.S. Treasury bonds, a proven diversifier during periods of equity market duress, when diversification is really needed the most, right? The whole reason they have the bonds in the portfolio, they're kind of foregoing to overweight these high yield bonds. Another approach, which would be the second line in the chart, is really they increase current cash flows by shifting some or all of their fixed income allocation into dividend-paying stocks. But at the end of the day, stocks are not bonds, and stocks will perform like stocks, meaning higher volatility and the potential for greater losses. And another thing they could do with the dividend-centric equity is to shift some of their broad market equity to overweight income-focused equity. But this could actually result in inadvertently changing the risk profile of the portfolio, because dividend-focused equities tend to display a significant bias towards value stocks, and this could result in a more highly concentrated portfolio. So investors who are employing strategies such as these are certainly sacrificing some of their diversification benefits in hopes of increasing their current income. Similar to asset allocation, we've deemed the value of following the total return approach to investing significant but too unique to quantify, because each portfolio's composition, where they start from, their risk tolerance and their goals are highly individualized and variable.
So we're going to move to the last module of the exercise, and it is the largest module. And here it doesn't quite matter whether you're advising an institutional portfolio that's all tax exempt, because really this is just human behavior. I mentioned earlier we've done research on investment policy at the institutional level. In addition to Vanguard working with advisors, we also work with significant number of institutional investment committees consultants, and others. And so you would see the same behavior if you were to go look at one of the top consultants that are out there, whether it relates to hire fire decisions of their investment manager or just staying the course into the policy portfolio. This here, Vanguard certainly is not alone here. Some of our competitors and some of our partners have also shown the IRR to TWR drag. Again, I just want to refresh everyone. IRR is the internal rate of return, which measures the actual return investors receive because it dollar weights the timing of those investments. And so we have long studied the IRR, TWR, and even our own funds here at Vanguard. We are, as much as we do on client education and as much as we try to get out the word about, buying high, selling low, and the risks of that, we continue to see investors struggle with their behavior choices. And so, here the value added is about 1 to 2%, if and only if, we can actually, do this ourselves as advisors, as stewards for our clients. Here, the good news is we do see very differences in the type of funds that are used. So you see a much lower IRR, TWR drag in funds that are balanced funds. For example, Vanguard and others have a suite of funds known as target retirement funds. You don't see investors timing balanced funds. You also don't see it much with index funds. Where you really see the biggest differential is in funds that are narrow and have high dispersion. So, for example, if you were to just take the total stock market and divide it into the 9 box, you would see that each of the 9 box looks significantly worse than the total market on its own. Sector funds are another area where investors and or advisors really struggle. So the more narrow and the more differentiated the fund is to the total market is where investors really struggle with these decisions. Obviously, this is important. I showed you earlier in my rebalancing slide about how investors are on drift and did not rebalance the portfolio. Here's a slide showing from the market peak 3 different allocations of 100% stock, which is the blue line, 50-50, which is the yellow line, and then a more conservative 30-70. All of these portfolios have recovered very, very nicely, and investors are up between 30 and 40% if they stayed the course. But I showed you earlier that investors were at about 63% in 2007, and they actually went to the low 30s in the bottom of February 2009. So, you could just draw a flat line across a lot of these allocations, and many investors, quite frankly, are still not whole because they either did not rebalance or left the market. So the destruction here of behavior is significant, and working with clients to keep them invested, to me, is one of the critical role an advisor plays. And I'm a big believer in being marginal or incremental, meaning that, a lot of times this is a negotiated process or a compromise process. If the client entered the bear market at that middle line 50-50, and they're down 24%, and now because the market slid, you're asking them to sell bonds and buy stocks, maybe they won't go all the way, but if you can try to get them half of the way there, so if they fell to 40-60, trying to do some of the work and certainly not letting them, leave all on their own, which could be very, very detrimental to their long-term wealth. Beyond stocks and bonds and chasing returns, I mentioned higher fire terminations. This is another research report that me and my team produced. So here again, it's not just chasing stocks and bonds or emerging markets or credit bonds. We see the same behavior as it relates to alpha strategies or active strategies. On the right is cash flows into the star ratings. We're all familiar with Morningstar star ratings. So what this shows is that 100% of cash flow goes into 5- and 4-star funds. Morningstar is a great partner. We work very closely with them. I was a little concerned how they would take our report. And again, we put this report out 2 years ago. And what this shows is that while 100% of cash flow goes into 5- and 4-star funds, 5- and 4-star funds have actually, once the star rating is assigned, has not been a very good predictor of forward-looking performance. You can see on the left side of this, it shows that once you are assigned a 5-star rating, you've gone on to underperform by 136 basis points in the subsequent period, 4-star 122, and vice versa. And the conclusion is this is not to go buy 1-star funds or that the star rating is not, worth anything at all. And I think Morningstar, to their credit, they came back after this study and said that costs are actually a better predictor than the star rating. And if you use the two together, you come out with a pretty good answer. So certainly whether you're, following performance of stocks and bonds or following performance of your active managers, a lot of using historical returns, and we all know past performance is not, a guarantee. I would say using past performance without costs is a very, very tough headwind to overcome, as shown by this and some of the other slides we presented. Indexing, Ali mentioned the adoption of indexing and ETFs. I think more and more advisors are moving towards a fee-based concept. And actually, survey after survey, the interesting thing is end retail clients that advisors advise, and even at Vanguard, have a very hard time even differentiating is their fund an index or active fund. And so I think we're seeing, the studies that show indexing outperforming 70 to 80% of active managers and the need to lower all-in costs, I think we're in the second or third inning towards the adoption of indexing and ETFs as the core of the portfolio. That doesn't mean that if I look out 10 years from now, I'm going to see the advisor community have 100% indexed, but it probably is going to be where the core component 5 years ago was 10 or 20% indexed, moves to 50 to 75% indexed, and the satellites, if you will, as a percentage of the portfolio shrinks from 90%, potentially to 20 or 40% as advisors become comfortable with their value proposition, not on selecting active managers. That past slide probably is a good indication that it's very difficult to do. And the acceptance of end clients being very happy and accepting of having indexing as a core.
Great. So that's really the conclusion of the 7 modules, and I guess we're going to move into why we believe our Advisors Alpha framework is a win for clients and advisors alike. So clients are going to keep more of the returns that they earn, giving them greater wealth and a greater chance of achieving their long-term goals. Advisors charging a fee on this wealth will not only earn more revenue, but will also increase client loyalty and retention. And as we know, client retention is really important, especially in a fee-based asset management framework. So think about it. What would it take for a long-time client to leave your practice? One of the most common responses we hear from clients and advisors alike is a period of significant underperformance relative to the market. And how can this happen? We believe significantly tilting client portfolios away from market cap weighted portfolio or engaging in large tactical moves can result in meaningful deviations from the benchmark return. And in our opinion, this would increase the likelihood of clients leaving your practice. So let's walk through the chart It shows the distribution of a portfolio's returns on the bottom. The line in the center of the distribution represents the benchmark's return for a market cap weighted portfolio. To the right of this line, the portfolio is outperforming the benchmark, but as you move left, meaning you underperform the benchmark, clients begin to ask questions. And the further you go to the left, the more likely a client is to remove assets from the relationship. So what can you do about this? So how can you prevent this, especially given that asset retention is so important? In our opinion, to shrink the distribution and minimize the risk of losing your clients, we would, as Fran just had mentioned, suggest making broad market index funds and ETFs the core of your portfolio. And if you feel very strongly about having active preferences, obviously just limit the deviations to levels that your practice and your client can withstand, especially during periods where there's significant underperformance for those preferences. As this chart is showing here, is that the broad market index funds as the core is going to reduce the opportunity for significant underperformance relative to the benchmark. Obviously, the more the portfolio looks like the benchmark, the less likely you are to underperform it. So in our opinion, the markets are uncertain and cyclical, but your practice really doesn't have to be.
Which, kind of closes on something else we developed in the paper, which is the advisor alpha J curve. I mentioned at the beginning, I've been at Vanguard for 17 years, but before Vanguard, I actually had an RIA practice for 10 years. And what we learned and discovered, which I'm sure you all learned and discovered, is that the onboarding process, first the business development process, trying to court new clients, and then the onboarding process, getting all the clients' assets to your organization, getting all the statements aligned, having the portfolio look like yours. It's a sunk cost in years, prospecting phase through the first 2 or 3 years. So all the costs, or the vast majority of the costs, are front-end loaded. So as Colleen mentioned, the key to success is tenure with your client. And so really what you're trying to do is increase the tenure or the longevity of the client. And what we came to discover, at least where I was, and this is going to be unique for every practice, is we ended up having the vast majority of our clients' wallet, meaning we had 70, 80, 90% of the wallet. They valued the relationship. They valued the personal contact. And investors hate change. People hate change. And the only reason you end up leaving the client, the client ends up leaving the practice is 2 slides ago we saw significant underperformance, right? So survey after survey says, why did you end up leaving the practice? One is communication, meaning not communicating regularly, frequently. And then the second is significant underperformance. And so thinking about what having a broad index core can do, shrinking the distribution around that is really focusing the relationship on the areas that were described in this module. And we are pretty confident this will lead to higher client tenure and lead towards this J curve of annuitizing your practice. So I want to conclude and be respectful. We have an hour, so we're coming up on the end of that, so have some time for Q&A. Conclusion is we firmly believe that most investors on their own would benefit from adopting the Advisor Alpha framework. That doesn't mean just working with any advisor. It means following the framework that we outlined in the paper and in the slides we just discussed. We feel if an advisor does this and clients go down this road, we believe that it adds about 3% in net returns. And I want to be very clear, it's net returns. If a balanced portfolio has a return expectation over the next decade of 7, we're not saying that the investor is going to get 10. What we're saying is if the unmanaged portfolio benchmark gets 7, and you work with a fee-based advisor and you do all this really well, maybe the end client, gets 5.8 or 5.5, which is probably much better than if they did this on their own, or we're working with an advisor who was not focusing on tax efficiency, spending efficiency, behavioral coaching, and that client may end up getting 3 either on their own or through a practice that is doing many of the other activities of the advisor community 10 years ago or 15 years ago. Lastly, I'm very clear that this will not show up on a client statement, right? So we have to articulate the value of alternate paths that many clients would have done on their own had they not been working with you. How do you measure a client's success or keeping that client rebalanced in February of 2009, and by working with you they stayed rebalanced as opposed to leaving and going on to money markets? That doesn't show up on the client statement because the benchmark adjusts to whatever the client portfolio did. And lastly, we are very convinced that the Advisor Alpha framework is not only good for end clients, your clients, but also very good for your practice because we think it will significantly increase client tenure, which is the key to the profitability model of most advisors. I want to thank you very much for your interest, and I'm going to turn it back over to Ali to help close us out.
Thank you, Fran. We have precious little time for questions, unfortunately, and quite a few good ones have come in. So I would ask you if you might provide a contact number where some of the attendees who ask a lot of these good questions would have a way to get their questions answered. Again, quite a lot of them and quite a lot of good ones. And we can also aggregate these questions and see to it that they get answered that way as well, whatever your preference is. But I think there have been so many questions here. Perhaps you can just provide a contact number straight away. Is that possible, Fran or Colleen?
Sure. Do you think a phone number is better or just an email probably?
Phone number, email, website, you name it. I think all the more vectors the better, because I'm telling you there were a lot of good questions, and you'll certainly see them.
Yeah, sure. All of the research is on our Vanguard.com. We actually have a dedicated site for the financial advisor community. So all the research, we mentioned it. Each one of these modules has its own white paper behind it. And then within there, there's actually the ability on the advisor's site to ask a question that someone can certainly get back to them.